So you've done the smart thing, right? You've locked your money away in a fixed rate savings account to get a much better return. But what if I told you that very savvy move could be about to land you a surprise tax bill from HMRC? It's a bit of a hidden trap and it's affecting millions. Today, we're going to show you exactly how to spot it and, more importantly, how to avoid it. We're able to bring you this important breakdown today thanks to the experts over at My Tax Accountant. They see hardworking savers get caught in this exact situation all the time. And they've shared their insights with us to help you get through the tricky UK tax system. So let's just get straight to it. Is it really possible that years of interest you've patiently been earning could be taxed all at once in a single tax year? Well, the answer is a huge yes. And it could honestly cost you hundreds, maybe even thousands, more than you ever planned for. So here's how we're going to break it all down. First, we'll pull back the curtain on the tax trap itself. Then we'll dive into how HMRC's math can kind of work against you. We'll look at a real-life tax shock, show you how to check your own risk, and finally, give you the game plan to avoid this trap for good. Okay, first up, the hidden tax trap. And to really get your head around the scale of this, you just need to see how many people are walking into it right now, completely unaware of the financial headache that's waiting just around the corner. 2.4 million. Yeah, you heard that right. That's the staggering number of fixed-term savings accounts that are set to mature in just the next 3 months. Let that sink in for a second. Millions of accounts are about to pay out. So what does that actually mean? Well, it means millions of us who've been diligently saving are about to get our original cash back, plus all those years of interest, all paid out in one big tempting lump sum. And that phrase, lump sum, well, that's the crucial detail here. And here's where the alarm bells should really start ringing. Out of those 2.4 million accounts, it's estimated that nearly 900,000 of them, that's almost 1 million, will generate enough interest to automatically trigger a tax bill. We're talking more than a third of all of them. And look, don't just take my word for it. Financial expert Laura Suter over at AJ Bell is warning that many people just don't realize these accounts can cause a really serious tax headache. The problem isn't that you're saving money, that's great. It's how that interest gets paid out, and crucially, how HMRC decides to tax it. This brings us to the absolute core of the problem, lump sum taxation. See, HMRC's rules say that you get taxed on your savings interest in the year you can actually get your hands on it. So with a 3-year bond, all 3 years of that lovely interest you've earned counts as income for this tax year alone. It's not spread out, and that one tiny detail, that's the entire trap. So how does this lump sum actually become such a painful tax bill? Let's peel back the layers and look at HMRC's own numbers to see exactly how their calculation works for the 2025/26 tax year. Okay, here are the current income tax bands. Now, the key thing to notice isn't just the rate, it's the thresholds, especially that higher rate one at £50,271. Because these thresholds have been frozen, they aren't going up with inflation. This has created this thing called fiscal drag, where even small pay rises are shoving more and more of us into higher tax brackets. And that makes this whole lump sum problem 10 times worse. Now, on top of your normal tax-free allowance, you also get a personal savings allowance, or PSA. Think of it as a special tax-free bubble just for your savings interest. If you're a basic rate taxpayer, you can earn a pretty generous £1,000 in interest totally tax-free. But, and this is so critical, the second your total income for the year tips over into that higher rate band, your allowance is immediately and brutally cut in half, down to just £500. Let's make this real. Imagine you saved £30,000 in a bond. If the interest was paid out to you every year, it would probably stay under your £1,000 allowance. You'd maybe end up with a tiny tax bill, something like £243 over 3 years. But with a fixed-term bond, you get over $4,000 all at once. That one payment can smash through your allowance and push you into a higher tax bracket, leaving you with a bill of £643 or even more. Same savings, same interest rate, a much bigger tax bill, all because of timing. Crazy, right? So, numbers on a slide are one thing. But what does this tax shock actually feel like for a real person? Let's walk through a quick case study to see just how damaging this can be. So this is Sarah. She is a nurse from Birmingham, works incredibly hard, and earns £49,000 a year. Now that salary puts her firmly in the basic rate tax band. A few years back, she did the sensible thing and locked £50,000 into a fixed-rate bond to save up for a deposit on her first home. This year, her bond matured. She checked her account and was absolutely thrilled to see a massive interest payment of £6,750. Amazing news, right? She thought her house deposit was finally within reach. But remember that lump sum rule? Well, in the eyes of HMRC, Sarah's income for this year isn't $49,000. Nope. It's her salary plus that entire chunk of interest. Her total taxable income suddenly skyrockets to $55,750, pushing her well over that critical higher rate threshold. And this is the really painful part. Because she's now officially classed as a higher rate taxpayer for the year, her tax-free personal savings allowance gets chopped in half. It goes from a healthy £1,000 all the way down to just £500. So not only does her tax rate on the interest jump from 20% to 40%, but her tax-free buffer has shrunk at the exact same time. It's a brutal double hit. And here it is, the final, shocking bill. Sarah's unexpected tax liability on her savings interest comes to a whopping £2,400. She was maybe expecting to pay a few £100s at most. Instead, she's facing a bill that wipes out a massive chunk of her house deposit, all because of how her interest was paid. And here's a quick pro tip, because honestly, this goes way beyond just income tax. A sudden spike in your income can trigger other alarms. If that lump sum pushes your total income over £50,000, you could suddenly have to start repaying child benefit. If it pushes you past £100,000, you actually start losing your main tax-free personal allowance. And a final crucial warning, never ever blindly trust HMRC's automated tax codes to get this right. You have to be proactive. Okay, so now that you know the danger, how do you actually check if you're at risk yourself? Let's get practical. Here are the exact steps you need to take to see what you might be up against. Here's your 5-step check. It's pretty simple. 1. Start with your total annual income, from your job, pension, whatever. 2. Add the full lump sum interest payment you're expecting this tax year. 3. See if that new grand total pushes you into a higher tax band and check what your personal savings allowance drops to. 4. Calculate the tax you'll owe on the interest above your new, probably lower PSA. And 5, and this is absolutely critical, log into your personal tax account on the HMRC website to see what your bank has reported and make sure it matches your numbers. Please don't just assume HMRC has it right. Right, so that 5-step check is a really powerful tool to see your immediate risk. But what if you want to plan ahead and make sure you never have to worry about this kind of surprise ever again? What's the best long-term solution? After all this, you might be feeling a little bit anxious. Are you calculating it correctly? Are there other tax things you might have missed? Could you be about to make a really costly mistake without even realizing it? That anxiety is completely normal. I mean, let's be honest, the UK tax system is notoriously complex. The rules are always changing. So for something this important, getting a second pair of expert eyes on it is the surest way to get some peace of mind and make sure you're not overpaying a single penny. The team at My Tax Accountant are absolute experts in this exact area. They can help you understand your position, plan ahead for any maturing investments, and just make sure there are no nasty surprises waiting for you from HMRC. For a quick chart, you can reach them on WhatsApp or by phone at 07854 255 375, or just drop in an email at info@mytaxaccountant.co.uk. So now you know about one of the most common and frankly unfair tax traps for UK savers. For more expert breakdowns that can save you money and a whole lot of stress, make sure you subscribe to the My Tax Accountant YouTube channel. Thanks so much for watching.